Hey, Saretsky here. Welcome back to the show. Quite a few things to touch on this week. There's a lot happening in financial markets, which we said was going to be very, very important as we get into September. It's an important time of the year for the housing market, sort of that September, October. There's a lot of central banks coming out with decisions over the next couple of weeks. It's going to, of course, influence mortgage rates and the direction for the Canadian economy, housing, etc. So all very, very important. Last week, we did a video showing Canada's second quarter GDP outright contracting by 1.6% on an annualized basis, and said, listen, okay, the rate hike odds of the odds of the Bank of Canada rate cut were increasing, and they were increasing because the Canadian economy was deteriorating. It wasn't getting better, it was getting worse. And so while many homeowners might perceive this as a positive news, in reality, again, you have to always ask, well, why are they cutting? And it's because things are ultimately getting worse as a lot of the tariff stuff is ultimately filtering through now into the Canadian economy. So again, last week, outright contraction in Q2 GDP. Now, remember, in July, we learned that there was a 41,000 people contraction in the labor market in terms of jobs. We just got the data today, actually, the data that I'm recording this here on Friday. 66,000 jobs lost in Canada. So back-to-back months of job losses in Canada. The unemployment rate rising to 7.1%, the highest outside of the pandemic, the highest in 9 years. So again, just to kind of recap, you have GDP, the economy outright contracting, and you have the unemployment rate moving higher to the highest in 9 years outside of the pandemic. So things, again, are getting worse, not better for the Canadian economy. This is ultimately going to prompt a rate cut from the Bank of Canada in September. So just a couple of weeks ago, the odds for BOC rate cut in September are roughly about 40%. The market odds, again, market implied pricing is basically like financial instruments that basically bet or wager on what the Bank of Canada is going to do. Those odds have now risen to a 90% odds of a rate cut from the Bank of Canada in September. So we fully expect a 25 basis point cut from the Bank of Canada because, again, people are losing their jobs. The economy is contracting. We, of course, saw PM Carney coming out and now announcing a $5 billion stimulus package. So sort of these support aids are coming through. This is all very, very important for the bigger picture, which we're going to get into in just a second. Now, again, keep in mind, I just told you that the economy is contracting, we're losing jobs, and population growth, which has been such a boom to nominal GDP and to the housing market and to rent growth and et cetera, et cetera, et cetera. If you look at the population growth in places like BC and Ontario, your two sort of most frothy housing markets where you've seen ultimately where a lot of the immigration goes is into these two provinces where you have a lot of jobs and opportunity in big metro cities. Is you're seeing population growth is effectively running at zero. Population growth is effectively running at zero in these two major provinces. And even across the rest of Canada, it has come down dramatically. And we are now seeing, again, a huge pushback from a temporary foreign worker program. We learned this week that not only Conservative government coming out and saying we need to basically pull the rug on this program, but we were even seeing more left-leaning governments, David Eby of the BC coming out this week and saying, listen, we also need to get rid of this temporary foreign worker program, or at least refine it dramatically, because basically again, the political pressure is rising. Canadians are seeing job losses, the unemployment rising to north of 7%. You have youth unemployment, the highest levels in 2 decades. This is putting political pressure on governments to say, hold on a minute, why do we have all these foreign immigrants coming in and taking jobs that are so desperately needed by Canadians as the unemployment rate is rising? And so what we're seeing effectively, again, to put it all into context, sort of the three drivers of Canadian growth are sort of contracting, right? You've got GDP contracting, you've got population growth contracting, and you've got the labor market contracting. And so these are all very, very important to watch moving forward. Now, I suppose if you're renewing a mortgage, there is going to be some rate relief. We know that 60% of Canadians are renewing a mortgage in 25 and 26. The people that are most at risk of these mortgage renewal rates is the people that took the 5-year fixed mortgage 5 years ago and are now renewing, we'll see about a 15 to 20% payment increase. Now, what we saw um, post jobs report today, after again seeing the contraction, the unemployment rate rising, the Canada 5-year bond yield fell about 10 basis points. So you are going to see fixed rates probably come down in the next couple of weeks as a result of the weakening economy, and that is dragging those bond yields lower and allowing some rate relief. Again, the rate relief is going to be very, very minor. We're talking maybe banks dropping 5 to maybe 10 basis points. So again, we'll put most fixed rate mortgages today still kind of around that 4% mark. And again, if the Bank of Canada cuts I think in the next week or two, you'll see those variable rate mortgages. They'll probably be around 3.85 to 3.9 is what you'll typically see on the variable rate side. So again, not a huge change, not certainly not something that's going to change the direction of the housing market, but this is again, I sort of want to emphasize this to people that are watching this video trying to make decisions in the real estate market today, which is exactly what I talked about last week, is we know the direction of where the economy is going. We know where it is today. We know where it's going, which is things are softening. And that's why the Bank of Canada is going to be cutting rates, is because things are softening. They are getting worse. People are losing their jobs. That is not typically a strong catalyst for a bounce back in housing when people are losing jobs and people worry about the growth prospects in the economy. So, we have typically a seasonal time of the real estate market. You have September and you have October. If you did not sell in the summer, you have basically another 8 weeks here where you typically will see a little bit of uptick in activity before things really slow down. And the question is, do you want to be sitting on the market for sale come November, December this winter? Or do you think that the housing market is going to bounce back in November or December this year? So again, if you're holding inventory and you have to sell or you really need to sell, your time to do it is in the next 8 weeks, because you're highly unlikely to see the housing market bounce back in the depths of the winter market when things realistically aren't looking like they're going to be that rosy. If you're going to sort of see a change in housing market conditions, you're likely to see those in the spring market. But the spring market, again, doesn't typically start until, call it, March. So if you're holding inventory today and you're not sold by, let's say, end of October, you could be looking at basically repositioning and coming back to the market and hopefully seeing some different conditions in March of 2026, which then begs the question is, how long do you want to wait? How long can you wait for market conditions to change? And they might not change by the spring of 2026. It might just be the same. They could be up, they could be down. Nobody has a crystal ball. I'm certainly not going to sit here and predict where the housing market will be 8 months from now. But what I can tell you today is we have a pretty good outlook of what the housing market looks like in Q3, Q4 coming up. So I think it's important because all you have to do is look at the data, and the data shows, if we look at what's happening in the Vancouver housing market where I am, the home price index, you're seeing sales activity bouncing back up on the backs of lower prices. Home prices down 4% across the board. That's per the home price index. But in reality, it's probably double that. It's probably closer to 8% on a year-over-year basis. Again, when you have a home price index, it doesn't necessarily capture all the illiquid stuff, the stuff that is not selling, even with price reductions. Those don't show up into the sales data. And so I would argue that you're actually seeing a sharper decline in home prices. And ultimately, when you look at what's happening on the inventory side, is you've seen months of inventory growing, particularly in places like the condo segment. If you go to the Fraser Valley and the suburbs, where you saw tremendous growth in condo prices. In fact, condo prices more than doubled since 2015. So over the last 10 years, condo prices in the Fraser Valley have more than doubled, which is absolutely incredible. And so those markets are now coming off the sharpest. You're seeing months of inventory. You've got over 10 months of inventory in the Fraser Valley market. Now, they say balanced market is typically somewhere between 4 to 5 months. You've got double that. You've got 10 months of supply on the market. So again, you have to ask yourself, well, what's it going to take to sort of clear that inventory and start to see a change in market conditions where prices basically say stop falling, flatline, and then go back up. And again, I don't think that is in Q3 or Q4 of this year. So all you have to do is look at the data points, and the data points will sort of guide you in the direction of where things are going over the next several months. Again, this channel has never been designed, nor do I believe in forecasting markets 6 to 12 months from now. But I think the evidence is pretty clear that we know where the market is and where it is going over the next 2, 3, 4 months. Um, the writing is on the wall. So that's kind of what we're seeing in the space. I think there's still a lot of issues. We've talked about all of this that I brought up today is, again, you have to ask yourself, well, which segments of the market are going to be most impacted? I still believe that's really in that new construction sector. Just got back from an outing, a dinner with a whole bunch of commercial brokers in the space, a handful of them, and you just talking about the dynamics of the housing market. And what you have today is basically um, no very few sites today make sense to basically redevelop. Again, you because of the conditions I've outlined in the resale market, nobody wants to buy a pre-sale. There's no demand, there's no investor demand for those resales. The projects aren't viable, and you have a lot of these developers sitting on this land that you can't develop because it's not financially viable. You have the cost of interest to service the land loan accumulating, right? Every single month you're paying interest on this land loan. And if you want out, you then have to sell the land, but the land values have come off dramatically because none of it pencils today. So you don't really want to sell into this environment either as a developer. So you're just sort of stuck hemorrhaging interest payments every single month, which ultimately, if you're a developer that has extended yourself across multiple land sites, you'd be looking at a scenario where effectively the interest payments will bankrupt you. And that is what we're seeing. We will see more bodies float to the surface in 26. That is the writing on the wall, is inevitable, because it is going to take time not only for the resale market to rebound, but then later after that is when you have the pre-sale investor market will snap back, is always follows the resale market. So when you start to see clear momentum in a recovery in home prices, that is when you start to get investor enthusiasm back into the market, and it can allow you to then pre-sell units once again. And I believe that is still a ways to go. So a lot to sort of digest there, but a lot happening here over the next couple of weeks. We'll hear from a lot of central banks. Again, a lot will be cutting rates as economies slow, as jobs start to be lost, et cetera, et cetera, et cetera. We know what's happening in Canada. We'll continue to cover it every single week. And as always, hope this video helped. And I'll see you next week.